Welcome to Tony Byrne's View with news you can use. Tony has over 32 years of experience as a chartered financial planner and wealth manager. Tony's passion is to help you retire early and live the life of your dreams with no financial worries. Now to today's episode.
How to save inheritance tax when your life expectancy is low. If you are elderly or you are terminally ill and you only have a short life expectancy, then the planning opportunities for inheritance tax mitigation are fairly limited. So what can you do about it? Ultimately, the simplest and easiest solution is to either gift assets that are free of inheritance tax, such as gifts to charity, or to maximise your inheritance tax reliefs and allowances. Gifts between spouses or civil partners are free of inheritance tax, but on the second death, the widow or widower's estate becomes subject to inheritance tax unless the assets themselves are free of inheritance tax. For example, most pensions or the survivor's estate is protected by inheritance tax exemptions and or reliefs such as the £325,000 nil rate band or the £175,000 residence nil rate band exemptions. Another example is gifting some or all of your estate to charity. 100% charitable legacies exempt from inheritance tax. Believe it or not, gifts to political parties are 100% exempt. I wonder why the government introduced that particular exemption. No prizes for guessing there then. There are also valuable exemptions for agriculture and business known as agricultural relief and business relief. For example, if you've owned a farm or a trading business for at least 2 years, those assets will usually be 100% exempt from inheritance tax on your death. Quite remarkably generous in my opinion. Interestingly, a number of companies have created some very clever investments in recent years which take advantage of 100% business relief after just 2 years of ownership. Among the most popular of these schemes are AIM ISAs and inheritance tax schemes, otherwise known as ITS schemes. I just wanted to focus on ITS schemes for this particular blog, and especially regarding the Puma Heritage Estate Planning Service, or EPS. What I like about Puma EPS is that your investment is into a finance company, Puma Property Finance, that lends money to property developers. In effect, it operates like a bank. It lends a maximum of 60% of the property development, meaning there is always a margin of safety of 40%. That is a high level of equity. They have arranged lending of approximately £1 billion across more than 500 individual loans with no capital losses to date. That is a very impressive track record by any measure. The reason why it qualifies for 100% business relief against inheritance tax is because you are investing in a private trading company which has been approved by HMRC as a qualifying investment. Your investment becomes fully free of inheritance tax on your death after 2 years of investment. In return, you receive 3.5% a year income. The icing on the cake is that you can access your capital if you ever need it, so you can literally have your cake and eat it. In my view, this is an appropriate investment for someone with a relatively short life expectancy of, say, less than 5 years, someone who has surplus cash in a bank account earning minimal interest, and who has little, if any, income needs, a person who has an above-average attitude to investment risk and is motivated to save inheritance tax. So why do I think it is only appropriate for this type of person? Because the annual income is quite modest. It is not suitable for someone with a long life expectancy because what you would gain in inheritance tax savings, you would lose in lowish investment returns. It does not qualify for protection under the Financial Ombudsman's Investor Compensation Scheme. Also, as the company is a smaller one, it is considered higher risk. If you die less than 2 years after investing in it, you do not benefit from the inheritance tax saving. On the other hand, the company does retain a lot of security with the first charge on the property developments it is funding and is only lending 60%. It has never experienced a loss in any of its loans to date. It is backed by its parent company. The second icing on the cake is that they offer a life insurance policy for 2 years term which will pay your estate 40% of the investment cost, equivalent to the IHT payable if you were to die within 2 years of investing. By the way, there are other similar inheritance tax mitigation schemes on the market, meaning that if you ever wanted to spread your risk, you can invest into more than one ITS scheme. So overall, I consider this to be a fantastic investment for the right type of person. If you're serious about saving inheritance tax in a simple way and you accept the investment risk, you know it makes sense.
Thank you for listening to today's episode. If you enjoyed it, don't forget to share it with your friends and family. For more information, head to www.wealthandtax.co.uk.